Hey, good morning traders and investors, and welcome back to our Wednesday live stream show. I'm your host, Bennett Tyndall with TradingAnalysis.com. We appreciate you all taking time out of your busy Wednesday mornings to join us. We've got a good show in store for you all today. Happy Wednesday, April 13th. Just a reminder, markets will be closed Friday the 15th for Good Friday, so we are up against a bit of a short trading week. We've got market volatility continuing as expected last week in the indexes. We were looking at upside resistance that set us up for the wave 4 pullback or the wave 2 pullback in the NASDAQ that we were looking for. And it's really within the first couple of weeks of April that we feel markets will either confirm upside resumption or alternatively fall victim to the alternate wave counts that we've been tracking. But as we've reviewed, even with the alternate wave structure, we are not looking for a completed cycle degree wave 5 from the credit crisis lows. We have an alternate interpretation which would suggest we're actually inside of a higher degree ending diagonal. That would allow for a more significant retracement of the post-COVID low rally, but not post-credit crisis low rally. And we're not looking for a 50, 60, or 80% bear market such as some in the investment community have suggested. It's certainly been a year full of uncertainties and volatility, and it's been a challenging one, but we continue to see more charts in line with the upside resumption counts as opposed to the bearish alternate, where we only have a handful of stocks, industry groups, and index charts that would support that view. We'll get to the charts in a few minutes. Before we get to the charts, let's go ahead and bring in the trading analysis team. Good morning, Terry, and good morning, Alex. How are you guys doing today?
Good morning, Bennett. Good morning, Alex. Yeah, everything's doing good here.
Good. Glad to hear it. We've got some crazy weather here in Texas. How are things in your neck of the woods,
yeah,
Alex?
That's for sure.
Well, hi guys. Everything fine. Weather is nice.
Nice.
So everybody goes out, kind of catching a first sun.
First sun. It's like dark outside here, so we don't have any sun today. Yeah. I'm jealous. In fact, yesterday evening I was recording our member strategy update, and I got a phone call on my cell phone from the emergency services and answered it, and there were well, that was the tornado warning, and then I got another one that there were funnel clouds in the area. We've had some unusual tornadoes this year. You know, coming from California, I guess we were used to the earthquakes, not quite so bad in comparison to the tornadoes. But glad things are going well for you, Alex. Glad to have you in with us this morning. Market volatility in the crypto space continues, eh?
Yeah,
I see that.
Bitcoin has now challenging this 40K, and it's a very important level. If we break that sustainably, then we will open up 30K next. So we are still kind of gravitating around 40K currently. So we will see. I mean, definitely a decisive break of 40K will bring us pretty rapidly down to 30K.
Very good. And of course, Alex does have Crypto Lab tomorrow morning, 9 a.m. Eastern, right here on this channel. So hey, speaking of crazy weather events, before we get into the show, apologize for the small talk. Terry, have you gotten your Generac wired up yet, or is it, or I should say, plumbed in with the gas?
Well, it's been delivered and mounted, and the electricians have done their part. Now we're waiting on the plumber to come hook up the gas, and
nice.
I think they're scheduled to come in on Monday. So yeah, I'll be all set for the hurricane season should we have any more power failures here.
You can't beat it. All right, so
I ordered that thing in August.
Oh, that was August. Wasn't it was supposed to come January, right? And it got delayed a little bit?
Yeah, back in August they said, yeah, maybe January. And then January it was like, well, maybe March. And then March it was like, okay, the very last day of March I get it. So.
It's here, finally. Hey, at least you got it. At least you got it. All right, so traders, investors, we're going to take you through the indexes, and we'll be back on the other side to carry on into sector rotation as well as macro with Alex. Gentlemen, I'll see you on the other side. Sound good?
Yep.
All right, catch you in a few minutes.
Okay, then we're gonna...
All right, good morning. Once again, we certainly appreciate you all tuning in. Let's jump into it. Hard right edge of the Motive Wave platform. We're going to dissect the Elliott Wave count in the U.S. market indexes in times such as the market environment that we find ourselves in. Elliott is really our best form of forward-looking analysis, and it helps us to dissect the underlying collective sentiment at work in the markets. And in a year such as this, it is extremely important. So we're looking first here at the S&P 500. And what we're going to do is we're going to focus in on the more recent trading action. In the most simplest terms, in terms of a basic Elliott Wave count, we see two actionary waves separated by one corrective wave from the COVID lows, from March of 2020 into January of 2022. That's important, and that's going to come into the picture in just a few minutes. But let's go ahead now and take a look at our preferred view. Our preferred view would suggest that actionary wave into September of 20 was met with a corrective wave. That corrective wave yielded a second actionary wave into the January 2022 highs. If that's the case, price action into the January 24th or March area lows for the indexes has been another correction, which means we should see a third and final actionary wave, motive impulsive or motive diagonal, to complete 5 waves from the COVID lows. And that's when we think there could be the possibility of a larger 3-wave pullback before ultimately resolving higher, because we continue to see the highest degree of trend as still intact within the market indexes. So let's get off of the daily chart. We're going to focus in on what we have here in the orange circle. And in fact, we're going to go ahead and focus right on into the kind of final segment here from February into March, and then what we've seen from there. So off of the daily chart down to the 1-hour chart for context, I'm first going to just blow all of this wave count up. I'm going to delete everything you see here in front of you. When initially counting the S&P 500, we had established our wave 4 correction, meaning that second corrective wave that we talked about from the COVID low. We originally had this anchored into the February 24th low. What that would mean for us, and as we had been tracking, we had an initial motive wave up, a prolonged wave 2 pullback, up in 3, down in 4, and then up in 5. When we met last week, we made note of the fact that the 46.3730 high was just above the typical 161.8% relationship that you do see in wave 3 compared to wave 1. So that supported the idea that this was a wave 3 top and we were in a wave 4 pullback. That would be coming out of some sort of ABC or complex correction from January into the February 24th lows. Now that we have overlap of the structure, we mentioned last week that if we were to overlap this invalidation level in the S&P, that there was still an option that would maintain the motive structure from the index lows or from the higher degree wave 4 completion. And I'm going to walk you through that. Because first of all, number one, the NASDAQ 100, we were always looking at it as a wave 2 pullback, meaning we had the S&P and the NASDAQ not quite aligned in terms of the subdivision. The alternate view would suggest that the higher degree 4th wave correction actually completed in the form of a truncation into either the March 8th or March 15th index low. If that's the case, then what we have is a move up in a wave 1 position. We're in wave 2, and this is where markets are either going to confirm upside continuation or fall victim to the alternate wave count. What this does for us is it allows us to keep the bull case alive and move invalidation down to 41.6172. You could even technically put it into the March 8th low at 41.57, and we'll go ahead and do that together. Anchoring wave 4 into the March 8th low, we still arrive at a 5-wave subdivision of wave 1, and even wave 3 has a nice 5-wave move. So we have a valid extension within this mode of impulsive sequence. What this could suggest for the wave 4 is this, and there's a couple of ways you can decompose this. You can call this a combination, but what I found quite amusing and interesting is the fact that we can actually view this as a standard 5-3-5 zigzag. And you might be looking at the red exclamation point thinking, well, goodness, we just overlapped again. What's going on here? I'll remind you that on a closing basis, if there is no overlap of trend or overlap of the corrections, then it's entirely valid to be viewed as an impulsive structure. And if we drop our daily chart down to a line or closing basis, we can see clear isolation between those two corrections. So what that suggests to me as an Elliottician is that we can entertain the idea that this was a 5-wave move. You might say, well, with the overlap, let's just call it a diagonal. Wave 5 falls short of wave 3. So I would rather call it a mode of impulsive wave and allow for the intraday overlap, but the closing basis, we stay out of invalidation. What this would mean for the wave 4 is that both the A wave and the C wave had truncated 5th wave moves. The first 5-wave move completing here, 3 waves back, 5 waves down with another truncation. I'm not a huge fan of the right look, or I should say, I'm not a huge fan of using this truncated completion of the higher degree orange wave 4, but it's not wrong. It's not wrong. So for the time being, we're going to continue to look at this as a wave 2 pullback. And if we're in a wave 2 pullback, then we have a clear zone of support that should come in between the 50 and 78.6% retracement levels, 43.91 down to 42.56. I'm not going to speculate as to the subdivision of the wave 2 because there's 2 distinct possibilities. Possibility number 1, this is a big A wave. We get a 3-wave move up in B, push back to support in C. The second subdivision possibility would suggest that this is AB and an extended 5-wave move inside of C, which means markets are just going to keep probing downside support. But ultimately, the bigger takeaway here is that this allows us to keep the bull case alive north of 41.5787 in the S&P, and you probably can't read that, so I'll go ahead and increase the font size here. We'll make it bold, and you can see that wave count invalidation. So that's the S&P 500. In the event we break south of wave count invalidation, would we be automatically assuming our highest cycle degree wave 5 completed into the January lows, or into the January highs? I would say no. Even though going back to June of last year, we expected 16,000 in the NASDAQ to shut the index down for quite some time, or at least for a larger 6 to 8 month pullback, we can't yet substantiate such a view. So in the event we break wave count invalidation in this look, and let's go ahead and promote this a degree of trend and anchor it to our higher degree structure, which, by the way, the higher degree structure completes anywhere from June to October completion in terms of a time frame. But in the event we break 41.57 to the downside in the index, then what we would be looking at, as we've discussed many times on this show, is this. The 2 actionary waves separated by a corrective wave that I talked about from the COVID low would make up a wave 1 of a higher degree ending diagonal. Because unlike mode of impulsive waves, which need 5-wave moves, in an ending, and in fact even in a leading diagonal, the 1, 3, and 5 positions can actually be 3-wave subdivisions. This would say, okay, you have an actionary wave, a corrective wave, another actionary wave. That makes wave 1 of higher degree wave 5 ending diagonal, and that would set us up for a more significant retracement of the move that we've seen from the March 2020 lows. If this is the case, then the entirety of the move from the February 24th low has been corrective or counter trend, thus suggesting a break of those lows are on the horizon. This is a possibility that we're going to continue to dissect and digest with our clients over at Trading Analysis and update as things unfold. So that's the breakdown in the S&P 500. Let's hit the pause button and jump over to the NASDAQ 100. Here in the NASDAQ 100, we don't have to entertain a truncated higher degree wave 4 corrective completion because the index makes a new low March 14th, and in making that low, we complete wave C of a wave 4 standard ABC zigzag pullback. 5 waves down into January, late January, with a truncated fifth. Nothing wrong with that view at all. 3 waves back, and then an ending contracting variety diagonal to finish out the correction. If that's the case, the pullback in terms of a retracement netted between a 61 and 78.6% retracement on the upside motive swing, and we're now working the wave 2 pullback. Just like we looked at in the S&P 500, if we were to break wave count invalidation, and I'll go ahead and increase the size of that invalidation level, if we break south of 1320.40 in the NASDAQ 100, we would not be looking for the end of the world, but we would alternatively be considering the idea, just as we looked at in the S&P, that the move from the COVID low consists of 2 actionary waves or 2 motive waves separated by a corrective wave, and we're now going to be faced with a more significant retracement of the post-March 2020 rally. This is the alternate scenario. If I had to assign probabilities to these 2 views, it's a bit difficult to do so in the current market environment, just given the uncertainties that we faced. However, if I were to utilize strictly pattern development, I would say there are more stocks, more indexes, and industry groups in favor of upside resumption as opposed to the alternate. With that in mind, I'm still leaning, mostly in favor of upside resumption, but I'm going to continue to take this one wave at a time. It's been a challenging year, and we've stressed with our clients that the first couple of weeks of April are critical and really will establish upside continuation, or we're going to fall victim to the alternate. So a lot to be determined here in the coming sessions. Hope you guys enjoyed the update. Let's go ahead and take a quick look at Russell 2000, and then we'll wrap up. Russell 2000 small caps has been one chart within the index space that has been challenging and supportive of the alternate bearish scenario. However, there's an entirely valid corrective view, which would suggest you have a complex move into the February lows. That would represent wave 4. Notice the 4v2 measurement that I have below. This is a measurement of time elapsed in wave 2 of the same degree. We know corrections of the same degree often tend towards equality in either duration or magnitude. This is an instance where we have that guideline demonstrated and seen in duration. So time elapsed in wave 4 was equal to 2, darn near exactly. We also have a second guideline at work, and that's the guideline of alternation. Wave 2 in this instance was a sideways flat. This would make sense that wave 4 is a more directional complex. Generally speaking, you see these corrective patterns reversed. Wave 2 is the more directional zigzag. Wave 4 is traditionally the more sideways triangle or flat. Off the daily, down to the smaller time frames, it's looking a bit concerning in that from its February 24th low, and we'll go 195-minute time frame here, from the February 24th low, where we can call this ABCWX, ABCY to complete a complex correction, there is evidence of a motive wave. This can be counted as motive diagonal contracting. If that's the case, it is yielding a sharp retracement, which is typical post-leading diagonal. But if this starts to push the lows again, this is starting to resemble more of a 5-wave trend, and that would be of concern and something we're going to continue to track. All right, so that's it for me. Let's go ahead and jump back over to the trading analysis team. What do you guys think? You think we're making new lows in the indexes? Are they on the horizon? Or do you think this is just a shakeout move before we resolve higher?
That's to be determined. That's what we've been telling people. I says, we 2 or 3 weeks ago, we pointed out the patterns were laying themselves out to be a determination here in the first 2 to 3 weeks of April, and April was going to be a down month, is what we were seeing coming into the end of March. There, it was very easy to read and say we're on the downside, but the downside, the way it plays out, is going to give us a insight as to how the next several months are going to unfold as well. So, good job, Bennett.
Thanks, and give me just a second before we carry on. Tom, I'm assuming you are referring to the ABC move down from January to February or March. Is that correct, Tom? Just to clarify your.
What did he ask?
He said you have 3 truncations in your SPX count. Highly unlikely. I would. That's fine. And as we mentioned, there are multiple ways you can decompose this. You can call this a complex. And we have 3 out of W, 3 of X, and 3 of Y. You only have 1 truncation in this instance. So I wouldn't get too hung up on the higher degree wave 4 subdivision at this point. You know, it appears to be a 3-wave move. If it fails support and we shift to our alternate view, then so be it. But I would agree with you. It would be unusual to have a truncated 5th in A and C. We can call this a complex and arrive at the same conclusion and the same implications overall. Looking at the Dow Jones Industrial, you know, just a big 3-wave pullback. Just a big 3-wave pullback. All right, and Tom, if you want to chat more about that, I would love to do so. Always enjoy engaging with viewers, traders, talking about Elliott Wave counts. You can drop me an email. Be more than happy to chat on that. All right, let's carry on into Optima with Terry. You ready to rock, sir? Got the screen?
Yes, sir. Let's
ready.
Hit it.
Go. All right. Sounds good. We'll catch you on the other side.
Hello, traders. I'm Terry Long at TradingAnalysis.com here with your weekly sector focus. So last week, let's start off with this. We saw a return to corrective action in the indexes. And that followed a 3-week rally that we had from March lows, 3 weeks up. And these little green boxes here is 1 week on this daily chart. You can see there was our first down week last week. The S&P pushing lower to Monday and Tuesday this week now. The S&P is down just over 5% at the moment from those March 29th highs. Now, let's talk about what happened last week. So Monday, the action looked to actually possibly see a continuation of the prior week's rally, but Tuesday's sharp reversal led to a gap down here on Wednesday in both the S&P and the NDX. And from Wednesday's close, the S&P held losses to only 1.27% for the week, but they did continue through Friday here in the NDX, seeing about 3 times as much decline as the S&P. For the week, the NDX fell 3.59%. Now, obviously, not all sectors felt pain. As we can see over here in the sector performance chart, the healthcare sector was rallying in the face of broader market weakness. It was up 3.45% for the week. Energy continued its volatile trading and rose 3.21%. And staples, utilities, and real estate also managed some positive gains. Now, meanwhile, it was growth sectors, technology, and consumer discretionary hit the hardest, declining 3.82 and 3.10% respectively. But even value sectors, industrials, financials, and materials were on the declining side. All right. Now let's take a look at what's going on this week. The decline continues, though we did see a bounce in semis and technology sectors yesterday. In morning trading, those gains faded lower throughout the afternoon. After the first 2 days of trading this week, S&P is down 2.02%. The NDX is down 2.7%. You can see all 11 sectors playing negative. Energy reversing those gains that it had last week. Energy, I believe, will just continue to yo-yo back and forth. Over here in our sector leader scoreboard, let's take a look at the relative strength ratings of these sectors. The energy sector continues to hold its relative strength performance constant despite seeing a momentum fade going on 5 weeks now. It's been 5 weeks since we've seen this push, this rollover here, but it's just been a vertical drop. And this is very interesting. I'll show you a chart here of the XLE in a moment, and what this declining momentum plays out, how it plays out in the wave pattern. Now, staples, financial, and industrial sectors, they also continue to see further momentum declines. The financial sector is now pushed down here into the weakening quadrant with a yellow weakening trend evident. Also have that same weakening trend here in the industrial sector. Now, healthcare, materials, and real estate sectors are seen with both rising relative strength and momentum up here in the leading quadrant. And you can see the real estate sector continuing to accelerate higher in a northeasterly move. And now the material sector actually accelerating further. We're also seeing gains here in healthcare. All right, over here in the lagging quadrant, the technology sector has shed its momentum gains. We had seen a couple of weeks ago, we had seen this rising move in both of these growth sectors with momentum heading north, but then we get this sudden rapid shift change in semiconductors, mostly, I believe, pushing the technology sector with a neutral performance in terms of momentum and actually some loss of relative strength. We are still seeing rising momentum vector in consumer discretionary sector, but the velocity of that has slowed down week over week. Now, the communication sector for the last several weeks has been happy to just sit there and not really show its hand. Now, only on this latest tick, you can see now we're starting to get a hint of upward movement in terms of momentum returning back here to the sector. So I want to share just a couple of things. So with that declining vector, this is what we're seeing in the XLE. It's mostly a sideways effect here. We reached up and pushed up to this 2018 resistance levels and then rejected back during early part of March, pushed back up in the late part of March. We've basically been challenged by this overhead resistance at 79.50. Now, Bennett has been sharing his analysis work on this, and I don't think you showed this today, Bennett, but I'll show you your blue count that we've got this playing out in an ABC flat, and it would not surprise us if B could go a little bit higher, but we also see a retracement back down here in C. So look for another push lower with that volatile energy sector. So real quick here, let's pull up XLV. Let's get on that chart. I had Medtronics pulled up there because taking a look at this blue improving vector here. But in the XLV has been rising very sharply in an impulsive move higher that could take it to additional highs before we see a further correction. So don't let the price action this week fool you in what's happening over here in the healthcare sector. There's quite a large contingent of stocks in the leading quadrant. There's several that have pushed up now into the improving quadrant that will be available to join into and move into the leading quadrant should any of these leaders start to fade. And there's really only a couple of them fading right now. So I do see further growth there in the healthcare sector. Now, consumer discretionary sector also has several of these retailers popping higher this week. Ross Stores, Dollar Tree, Home Builder Lennar is really coming off of a big dip there. It has a 3% bounce. I don't know that bounce is over yet. I'm just saying that there's some pretty good moves there. Let's take a look at Ross. You can see Ross starting to move higher. That does only look like 3 waves up right now, but it is a pretty significant retracement of its past decline. And Dollar Tree, well, Dollar Tree setting all-time highs. Okay, Dollar Tree's continued to be the leader there, and we are still, even this week, pushing up to new all-time highs. So anyway, that's all I've got for now. In times like these, guys, it's difficult to think about taking on new bullish positions in any stock. My advice is to remain patient and wait for the market to confirm a new uptrend underway rather than trying to risk catching a falling knife. But if you do take on some speculative trades, trade carefully here, protect your capital for now. Okay, Bennett, I'll hand it back to you now.
Much appreciated. Thank you so much, Terry. As always, we're going to pass the screen over to Alex. Just made you presenter. We'll get set up to take you through some macro, and then at the end, got a little bit of an announcement and invitation for you all, so stick around. All right, Alex, sir, you ready to rock? Uh-oh, we've lost his audio.
Can't hear him. Are you muted, Alex?
Do you hear me now?
Well, we had his audio.
There
we are. You're back.
Okay, great. Yeah, let's go.
All right, let's hit it. We'll be back on the other side to wrap up, and with that invitation.
Hey guys, welcome to a little bit of a macro wrap up with some overview on the yields, also commodities, and a couple of charts in gold and silver. So let's start with the 10-year yields. As we already can see here on the May meeting, probability that Fed is going to hike 50 basis points, it's already almost 90%. So from the market perspective, that's almost guaranteed. We talked a lot about the yield curve inversion. That is a subject of many mainstream and hedge fund community talks and discussions. We also mentioned that a couple of times here. The yield curve didn't invert completely. Of course, Fed needs some time to catch up with a lower or a closer part of the yield curve. So in that respect, the next months are also pricing 25 to 50 basis points still differently. We will see how this will go, but definitely we are going to see several rate hikes during this year, definitely, in order for Fed to start kind of approaching these inflationary levels on the upside. Inflation levels even got higher, and they will go higher in the next couple of weeks, because the figures from the past weeks are going to arrive where the energy cost was pretty high. So on the 10-year yields chart, we are still moving upside. We were updating you last time at 2.33. We traded with the highs around 2.8. So we are still looking for this to go for the next resistance levels, which comes around 3.2 to 3.3%, where we are going to expect most likely just a small consolidation and the continuation on the upside. On the European front, 10-year bond, so this is the price, it's not the yield, just inverted. It's just a better wave count. On the price, we are actually hitting the first boundary of the support zone, and just kind of making a small pause here. I think I've shown you last Wednesday this forward 3 months Euribor, which is pricing in above 1%, around, or 1.35, around, I think, December 2023. So most likely ECB meeting will be very interesting. They might be, according to this market outlook, also starts to raise rates, but they are having a much, I will say, more difficult position than the Fed because of the war in Europe and all of this what's going on. So in that perspective, dollar is still going higher, pricing yields moving higher. So this is still functioning on the interest rate differential. We are trading now at 78.6 retracement from this level, from this move to the downside. So this starts to look like a ABC or a complete five-way move. Depends what we are going to do here. Definitely, I don't want to pick side here. If we take just a potential move on the upside in yields in the US, most likely euro might go even a bit lower and dollar higher, because ECB definitely is limited in regards of the moving rates on the upside. So I will say we might have a small pullback, and then if this E wave holds, we're going to see a little bit more upside in the fifth wave. So in regards of commodities, oil is consolidating. I've been talking about this last time. This is not impulsive move to the downside. As you can see, we are actually holding this level, and we are starting to consolidate here. When you see this type of a consolidation, and if we see that even in the next couple of days, that means actually that most likely the breakout will be on the upside further in oil price. Of course, I would like to see a little bit more of energy storage in this consolidation, and then a possible breakout further on the upside above this 140 level. There is a big debate, should of course Europe ban Russian oil. As you know, the dependence of European Union is rather big from oil and gas perspective. So this is still left to be seen. But the price action here on the Brent is showing consolidation, which for now implies possibly, if we continue to consolidate, higher levels ahead in oil. If we look couple of other commodities, one of the fascinating chart, this is the like 50 years of coffee price chart. I posted that on my Twitter a year ago. In regards of the mid price, which is $174, and we are trading now at 226. As you can see, we have seen these spikes, and these spikes are due to the weather, mostly in Brazil. When you have a freeze, there is a couple of definitions of how coffee can actually sustain the winter weather. It can be a soft freeze when the plant can recover, and you can have also a hard freeze when plant cannot recover, and that actually causes such a big spike in coffee price. But this was all in a supply side manner. And also we had a little bit of freeze, not so serious, but anyhow, all of this together make the coffee price actually went up to 265. I still do see it going higher. This is 1, 2, up in 3, maybe consolidation in 4, and up in 5. If we see the chart from the last week, soybean, very nice consolidation, 1, 2, up in 3, nice subdivisions here in 5 waves, pullback in a wave 4, might morph into a triangle, but still a very sideways price action with the resolution still higher in the 5th wave. If you look also a couple of other, I have a corn futures here, and there is also a nice development of a possible continuation here to complete actually this these 5 waves on the upside. So we can expect, and that also CRB index from Thomson Reuters suggests commodities, I think, has a little bit more higher, and I think we're going to see some type of pullback and then continuation on the upside in this cyclical inflationary cycle. So let's switch to gold and silver. Not much of a price action. We have seen some type of a consolidation on gold. In trading analysis, we usually do discuss this wave count sometimes between Terry Bennett and me. In general, we have a bullish wave count. I also have a bearish one because I didn't like the fact gold went just $200 on the upside in this warlike, a very dangerous situation. That for me is a sign that gold is weak for now. And I'm more inclined to look this as a 1-2 down in 3 in ABC than on the bullish side. But of course, I don't want to pick a side, because here we might be in a secondary wave to the downside, and then off we go on the upside. When you are faced with a sideways situation, which is actually all of this, you have to look a couple of scenarios, and then some small details and breakouts can actually be a nice very place to put some trades with a very small risk. For example, if you see this wave count, and if you count this a break of a triangle thrust on the upside, if you get the ABC on the downside, of course that will be some type of a corrective channel, and when this corrective channel is done, you will get something which will start to move on the upside, and that might create a breakout of this channel, small pullback, and opportunity for a very small loss to actually climb this trend on the upside. So we do seek this type of things, so that's why we also talk about the probabilities. And for now, I see here a probability. This is just a flat and with a little bit more downside if we are in the bullish scenario. Silver is also not doing much. It bounced a bit, but it looks like a lost case for now. So as you can see here, we are gravitating around this trend line. We moved down, now we moved up. We can argue this is not something impulsive to the downside. So if you look on a smaller time frame, you will see we had only seen some type of a three-way move down. We can see a three-way move up and then a continuation. So it is still not clear what's going on silver. I'm not so excited about the current price action in silver. I do think if gold goes down, silver will follow it. And then maybe when the conditions are for the dollar to move lower, they can be joined together and unison go on the upside. So we will see. Still kind of just a big sideways price action without any definite clarity in a sense of the Elliott Wave sequence for the let's say more probability that we're going to continue on the upside. So yeah, so the final conclusion from this type of kind of assessments is the rates are still going to go more on the upside. Inflation is getting higher, commodities are getting higher, dollar is getting higher. So on that front, that is all the environment, which is not so depends how the stock market is looking at it. It is not to, as Terry said, it's not the environment to be brave. Because anything can happen in this environment, and we are trying to actually clarify for you the probabilities of this. And for me, in this environment, if it starts to be sustainable, most likely we will see maybe a little bit more pullbacks than rather moving on the upside. So so be very careful, guys. Thank you. Back to you, Bennett.
Very good. Much appreciated. As always, Alex, curious to see where that dollar chart goes. That recent move up from the May 21 lows is starting to look rather impulsive. Things could definitely get interesting there. So, hey, we appreciate you all taking time out of your Wednesdays to join us. Before you get out of here, we've got company founder, former CEO, Mr. Todd Gordon, now co-founder and director of investments of New Age Wealth Advisors, joining us. He's got a webinar coming up. Good morning, Todd. How are you doing today, sir?
Good morning, guys. How are you?
Doing good, doing good. Glad to have you on with us today.
Hey, boys. Yeah, I was just listening along. You know, I'm doing some research for this, and Alex, I thought you might find this interesting. Can you guys see my screen?
We're going screens right now. Let's see. And you are good.
So I was just listening to Alex at the tail end. Alex, I was looking at. Do you remember a long time ago, gold silver? Sort of the inverse gold silver ratio was a great predictor for where the S&P goes.
No, I don't recall that.
Okay.
But
Okay.
it was the inverse chart of the gold silver ratio, kind of predicting where the S&P will go.
Right. So the long-standing macro relationship was obviously silver was precious metal, store of value, as well as industrial. So it kind of had like a risk-on flavor where gold was usually defensive. So if you look at a long-standing gold-silver relationship over the S&P, it was pretty inverse relationship, but silver has fallen out of favor. So I was looking at the new one and its yield spread, and I was just doing it last night. I was going to come on and talk about something else, but let me see if I can pop this up quickly. Oh yeah. So look at this. This is a 10-year yield minus 3-month yield. So our, what I think is the true spread overlaid on the CRB, which is the commodities index. Look at the correlation here. It's like, it was up to 70, 80% over the last 2 to 3 years. And if you pop this out, go like, out to 30 years. And I know stock charts is a little cumbersome in the way they act, but just in the last, we've seen a pretty good correlation here since 2013, 14, last 10 years. And you look at the very inverse relationship of yield spreads and commodities. But I think this is the name of the game here. So I guess it would make sense as longer term rates are moving up, as longer term bonds are being sold off. I suppose that's a long-term inflation expectation, and commodities are going to be moving up on that. What do you think about that?
Yeah, I think that's first amazing find. I remember I have outlined the gold silver ratio here, but without this, actually on that chart it is seen that silver is actually a favor in this environment very soon over gold, which is very interesting as well. If you look the gold silver ratio chart without this, silver has a nice and actually I think you are right about this. I think commodities will with this be favorable for at least a year and a half in advance. I agree completely, and amazing find.
This isn't the best chart. This is the old gold silver ratio. I'd have to find. I had a better one somewhere, but yeah, no, seriously, it'd be great to see silver come back. But hey, thanks for. I just want to pop in, say what's up, guys. Again, a lot of you don't know me, but founder of Trade Analysis, put this great team together. The team has taken the company to different levels that didn't happen when I was there. So just want to jump in on a few things real quick before you go off here today. Did CNBC yesterday. I for those of you who maybe remember me, don't think I don't trade anymore. I did CNBC yesterday, and I kind of mixed it up in the meme stock crowd, which is always fun. It's like 10 years ago, if you insulted the gold community, they would flame you. And then 5 years ago, if you say anything badly about crypto, they'll flame you. And now it's the meme stock. So we were talking about Bed Bath & Beyond, and just talking about earnings that came out, big activist play here. I was going to show you a little options trade here. I've gone over to Schwab here. I'm not as slick as I used to be. I get used to it. But just talking about meme stock, and Bed Bath & Beyond is sort of in the same camp as GameStop and AMC, and Ryan Cohen, who's a big activist investor, got involved here on this spike in Bed Bath & Beyond, and you're just watching it kind of go into earnings here. I was like, let's put a little option trade on here. So I was just going to kind of show you, just kind of make the point that I got flamed after CNBC on Twitter and Reddit. There's about 500 comments about what an idiot I am, and my head right up my proverbial butthole, because I don't want to be long Bed Bath & Beyond, and the earnings were a disaster. So it was, so I did this little option fly. So sold the 15 puts going in. We closed at about 17 into earnings. So sold the 15s and bought the 13, 18. So just a little fly in there, and just kind of going against the point that just be careful with these meme stocks, these turnaround stocks, activist plays. You can trade them, you can throw some options around in them, but I don't think they have any place, in a good, responsible portfolio. If you can separate what you're doing with the trade analysis crowd, and the crew there in terms of trading, this is your risk capital, but also have a solid portfolio that's invested in good companies, and fine if you want to be growth oriented. Have a good solid portfolio and separate the two. So I just want to bring it on. That's the way, I built trading analysis 10 years ago. So, be able to compartmentalize your two different trading accounts. You have your long-term investment account or multiple accounts, and you have your trading account. That's always the way we've sort of set it up there, and that's the responsible way. So I just want to mention, thanks for giving me the time here, guys. If you want to talk about sort of that other bucket, your longer term, facing all the uncertainty that we have in here. We have a webinar coming up actually tonight. My partner Ryan and I have been working hard on it. So, are you prepared to navigate today's highly uncertain markets? Future goals depend on it. We talk about all the challenges that are facing investors right now. And again, if I'm sure your short-term trading money is in very good hands with the team here. But what about the rest of it? Are you prepared for everything that's going on, and your goals for the next 5, 10, 15, 20 years, taking you into retirement? There's things that are happening now that will impact decisions you make now that will impact where you're going to be in the future. So I'll just drop this in the YouTube window here. Sign up tonight. It should go about 45 minutes. And if you can't make it, that's fine. We will send you an archive recording. So I just dropped the link in the chat there. So we'll see you guys tonight. It should be 8 o'clock. It's going to be a good event. Ryan and I both be there, and very much trying to talk about all the crazy cross currents that are happening that have really changed the investing landscape. Over the last 4 or 5 years, man, it used to be so easy, just be long tech and you're fine, but it's a different world now. So we'll leave it there. Hey, thanks guys for the end, and good job, Bennett, Terry, and Alex. I listened, and great job as always.
Appreciate it. Thank you so much, Todd. Enjoy your morning, and we'll see you on the webinar tonight.
See you guys. Thanks.
Take care. All right. Thank you all so much for tuning in. We appreciate it. Again, if you're interested in any crypto-specific coverage, we should also call it Crypto/Macro Lab with Alex tomorrow morning, 9 a.m. right here on the Trading Analysis YouTube channel. Members, we'll see you in about 15-20 minutes for our weekly member webinar. Viewers, again, thank you guys. We do appreciate you joining us here on the channel, taking time to see what we have to offer. Please visit us, tradinganalysis.com. I posted the link in the chat if you're interested in joining Todd and Ryan this evening over at New Age Wealth for the webinar. Good event coming up there. Markets are open, quiet, essentially sideways here from the close, or from yesterday's close, some overnight action, and we'll be back same time, same place next week. Alex, Terry, appreciate it.
Get your taxes done if you haven't done so this weekend. They're due on Monday, and have a happy Easter, everyone.
Absolutely. Markets close Friday, taxes due Monday. It's a good weekend. All right, have a good one. We'll catch you next week. Take care.